Good afternoon, everyone, and welcome to the presentation, some budgeting and cash flow tools you may want to consider as we go forward throughout the process of this new upcoming budget season, as well as new fiscal year for many of us. We're all being inundated with data. As my first accounting professor wrote on the chalkboard the first day of class, accounting is the language of turning data into information. And the goal of today is to bring you some of this information you can use as solutions. My name is Eric Berman. I am a partner with Eide Bailey in our Boise office. Joining me for this hour will be Cindy Byram, a partner in our Rancho Cucamonga office. But she's talking to us today from Joshua Tree, California. Manager Ian Berg is also joining us from the Rancho Cucamonga office. Ian is going to walk us through a cash flow modeling tool in Excel that you may find really helpful in your profession, in your job. It's self-evident that states and local governments are facing challenges that in some cases have not been seen in generations. Responding to those challenges to the best of all of our abilities is all of our collective responsibilities to our communities, the employees who work in those communities, and to ourselves. We know that there are no right and no wrong answers, as quite frankly, there's no playbook that will work in all circumstances. Our goal is to show you the tools to help make your government, giving them better decisions throughout this challenging period. Just remember, as many from George Washington to Vince Lombardi have said, the best defense is a good offense. With so much change and adversity out there, we just need to do something and think differently. Let's get started. Here's our speakers again. In today's agenda, we'll briefly discuss the current status of states and local governments, some of which is changing hour by hour, potential budgeting issues for governments, and then cash flow modeling based on those decisions. Just some considerations. There are over 90,000 governments in the United States, in addition to territories and tribal nations. Each is facing a different challenge, operationally, economically, and budgetarily throughout the crisis. Again, it seems that every hour the news changes, much of which it has an uncertain outcome. We really are trying to predict the future, and it's incumbent upon us to really consider perhaps worst case scenarios or scenarios we haven't really faced again in a generation, if not longer. There have been a bunch of analyses regarding the distress befalling states and local governments nationwide. No government is going to be immune, in my opinion. Moody's Analytics has been looking at states, and Brookings, that's the Brookings Institution, has been looking at cities, among other organizations. When you see the words inflict, significant, crisis, this is the real deal. Brookings is predicting stress in nearly every aspect of revenue generation for governments. And maybe you saw 60 Minutes last night with the chairman of the Federal Reserve on. He was making a few dire predictions, some of which are very wide ranging in terms of percentages and so on. And certainly you may have been reading things from various organizations around the country that have been studying this for the past 10 or 12 weeks or so. The dire predictions are already being seen where I'm sitting currently in Massachusetts. April revenues have dropped by 50% from last year. That's 50, not 15. 50% from last year, with sales tax dropping by 23%. Almost the entirety of sales tax was generated through e-commerce, which is something that has never been seen before. With the U.S. Treasury pondering extending the filing of 2019 returns from July to September, if not December, a further hole may be dug as many state income taxes around the country start at federal amounts and then adjust for state provisions. Of course, it is the state flows that drive lower levels of funding in many jurisdictions. Some of you may have been part of a town hall we held a few weeks ago. Since then, changes have abounded. Some states have opened portions of their economy. My state opened today for a very limited basis on construction and houses of worship. The success of the opening may not be known for several periods. Since then, states and local governments have laid off or furloughed close to 1 million employees, as reported by the Federal Bureau of Labor Statistics. Further, operations are starting to be analyzed on a go-forward basis by many governments. A simple question is what can we do on a go-forward basis versus what should we do for our citizens on a go-forward basis? This has proved to be a question with a different answer that could be difficult in many circumstances. As a prime example, the largest public university system, Cal State University, decided not to offer classes on campus in the fall out of an abundance of caution. What does this do to the university's budget and cash flow, along with the operations in the future? Not to mention all the other economic impacts of all the communities where those universities are. It's a tremendous decision. Moody's issued a report about 4 weeks ago predicting two possible scenarios, both with very different outcomes, but both looking like a tsunami. Moody's terms this tsunami the fiscal shock, which is comprised by the revenue drop plus the additional costs of COVID-19, less CARES Act funding for COVID-19 allowable costs and available reserves at individual governments. The Moody's report on its baseline predicted a peak jobless rate of 13% and a real GDP drop of 10%. The nation, to some, has already exceeded those figures, at least preliminarily. So we can probably discount that top line. In terms of the Moody's Analytics severe scenario, they assume travel restrictions stretching into the fall with approximately the jobless rate we are at now and a GDP drop of 14%. With each day that goes by, we're looking more and more like the blue line, despite the equity indexes going up about anywhere from 2 to 4% just today. This blue line far and away exceeds what we saw in the Great Recession, and certainly what we saw after 9/11. And of course, this is coupled with very high Medicaid costs due to COVID-19 and the trillions in debt that the country is facing. Using this information from Moody's, which is a potential but not just the only source, and remember, it's just a prediction. Let's just take a look at Oklahoma, for example, which is on this screen. And this is just one state. Moody's projects a 25% fiscal shock baseline, 31% in a severe shock, largely due to that state's oil price collapse. But other states do not have it so quote unquote good. In the upper left-hand corner, the state of Alaska has nearly an 80% projected drop, again due to oil prices. South Dakota fares a little bit better with a projected drop of 12.2%. This methodology may work for your government. Analyze the revenue impact, couple it with increased costs, some of which may be borne by increased grant revenues from CARES Act, and other sources to fill in the holes with reserves. But that last phrase is the problem. The more reserves that are used today, the less that are there tomorrow without structural changes. Looking further at selected states, nearly every government that you see in red is higher than the national average per Moody's. Remember, the key drivers are not just the decline in revenue. It's a function of COVID increased costs, the CARES Act funding that may offset some of those costs, and available revenues. Or available reserves, excuse me. If there's additional funding from the federal government, that's great, except that our children and grandchildren will be paying for it. My personal belief is that somewhere in the middle is probably a good starting point for many, many governments, maybe 15 to 20%. But notice, all are below 2019 revenues. Moody's, though, only looked at states. Yet states have a lot of financial influence over cities, but not all. Brookings' report looked at unemployment in local areas and a concentration of industries that may be at risk. Higher risk industries right now per Brookings include mining, oil and gas, the airline industry, and anything having to do with leisure and hospitality. We can all see it in our neighborhoods as to what is operating versus what is not. Just take a walk around. My personal belief is that commercial real estate will be under tremendous pressure due to the changes in how we all work. Think about it. Last week, Twitter announced that all employees can work from home permanently. What will Twitter do with all of its office space now? Keep it empty? There's a trickle-down impact from empty offices. Think of the lunch places, coffee places, office supplies, utilities, transit, daycare, all of which are impacted by offices being closed, and many of those places are tenants in buildings. Of course, commercial property owners pay property taxes. The higher risk cities have more than 15% employment in those industries in their localities. Cities are also judged to be at higher risk if they rely on non-property tax revenue for more than 25% of their revenues. This includes any fees or sales taxes. Certainly, there are higher risk areas around the country, including areas that rely on travel and tourism. Remember, Brookings targeted major drivers as oil and gas and discretionary spending, but there may be others. Cities may have to make changes more immediately. And these include cities in Texas, California, Arizona, and Utah, depending on their revenue structure. Other cities may have a little more time, as in many other states. Some of these cities have a larger balance in reserves or perhaps a smaller COVID-19 impact, or a smaller reliance on states. Still, other cities are a little more protected, including those with higher reserves, like in North Dakota, Iowa, Minnesota. Many of these governments didn't rise very high economically during the last 10 years or so, and therefore don't have very far to follow, or may have a built-in resiliency due to innovation industries such as high tech or biotech. Or it depends really on state government resources that are being provided. But just so you know, my own local government announced on Friday that it was laying off 1/4 of its staff, 196 people. My government was just rated by AAA as a AAA government by Standard & Poor's. So if a AAA government can lay off 196 non-education people because we budget education separately, something's really amiss. Of course, Congress may try again for relief for governments. There was a proposal that was passed late Friday night in the House of Representatives, which could be used to replace foregone revenues not projected on January 31st of 2020. States would have received $500 billion split between 2020 and 2021, with $1 billion as a baseline for each state government, including Washington, D.C., and then $199 billion annually with differing formulas. The funds could be used for COVID-19 related expenses or to replace foregone revenues not projected on January 31st of 2020. Local governments would receive $375 billion in total, of which $250 billion would be in 2020 and $125 billion in 2021. Could there be some elements of the HEROES Act that was passed by the House of Representatives on Friday night, part of a final bill? Well, that's up to time and, of course, politics. What I'd like to do, though, is to talk a little bit about many governments that are beyond states and local governments. The many governments are special districts within districts. within jurisdictions. And in many cases, they're legally separate from states and municipalities. Those special districts are especially at risk due to moratoriums on things like shutoffs or evictions, or perhaps worse, non-exchange financial guarantees by a related general purpose government. The state or city or county may have to step in to pay the debts or fund the deficits of these districts in the case of default. Special districts may need to be especially careful on budgeting and cash flow planning, but we have some solutions for you. And special districts could be especially vulnerable. I'd like to hand it over to Cindy Byram to talk to you about what we can help you with in this area. Cindy, take it away.
Thank you, Eric. My name's Cindy Byram. I have Ian Berg also on the line here. We specialize in special districts. That's 100% of what we do. There are literally tens of thousands of special districts in the United States. In California alone, there's over 4,000 special districts and 50 different types. So I'm only going to focus on a few of the types. I can't get to all 50, but they all share some general characteristics. I'm going to start with water and sewer utilities. Water and sewer utilities are getting hit very, very hard right now. As you probably know, most states are not allowing water shutoffs, although some are. We're not allowed to charge interest in California, late fees, penalties, collect on that. We're not allowed. We actually had to go back and reconnect customers that hadn't paid since March 4th. So just alone in that, most of my utilities have seen between a 10 and 30% increase in customers that aren't paying their bills. And that is going to compound. So if we have to go for 3 or 4 months without being able to collect that lost utility revenue, by the time that bill becomes due and payable, a lot of our customers are not going to be able to pay that bill. And we're going to have to bear the brunt of that expense. Certainly our bad debt expense is going to increase exponentially. There could even be some form of utility bill debt forgiveness where we're mandated to just say, we forgive you, let's start fresh. And certainly we have one district that is 50% commercial, and the drop in their revenue has been substantial. They have every day, anecdotally, every day they have somebody calling them, telling them, shut my water off. Somebody meaning a commercial business, because a lot of these businesses just aren't operating or can't afford to operate. The 2-month shutdown pushed them already over the brink. And then we also anticipate lower future property tax revenues. That impact may not happen for a year or two down the road, but it is going to happen. So some of my districts, water districts that rely more heavily on property taxes are going to feel that impact. A loss of development fees and growth revenues as areas build out. Certain special districts that are relying on increased growth are going to feel the impact of this. And certainly lower interest and investment income is certainly going to impact all special districts. Special districts like that focus primarily, their revenues are primarily focused on property tax revenues, should not see an immediate impact, but it will come down the road. And these are districts like fire districts that get their revenues from property taxes and benefit assessments. Libraries are closed right now. And when they come back online, they're going to come back in a different format. And it's going to be a whole new business model. Parks and recreation districts, there's no classes being held right now, or programs, recreational programs. So the loss of that revenue is there, as well as the property tax revenue. CSDs, community service districts, often have a mixture of both. They might have water, sewer, trash, parks, a variety of things, and how they handle each one of those subcomponents of that CSD is going to be different. Keeping in mind, a water district or a trash service has the option of raising rates. Something like a parks district where all you do is get money from property taxes, you don't have any rates to raise except for perhaps your program fees. Fire districts, same thing, there's nothing to raise to generate more revenue. And all of these districts, transit districts, are going to lose user charges and potential reimbursements. Resource conservation districts, a lot of our districts rely on grant funding, and what that's going to look like in the future is really unknown. How much money will be available out there for grants, we don't know, and they could be impacted certainly. And of course, they're going to lose investment, interest, and income as well. So revenues are going down, expenses are going up. So just the cost to sanitize, PP&E equipment. My water districts, they're having a hard time even securing the proper PP&E, and they're paying for it as well. Many of our agencies were not set up to work remotely, although, and many of them are critical agencies such as fire and water utilities, where they had to continue operating, had to send employees home because we still have to collect the water payments. We still have to go out and check for a leak, things of that nature, and had to send them home and had to buy laptops. So that was an initial cost that everybody was scrambling to get these remote services, consultants to get their website updates, and so on. Other costs are certainly going to be rising pension costs, and every agency is going to feel this. As the market tanked, so did the effect on our retirement expenses, which usually has a delayed effect. And that's why I think that rising retirement coupled with the delayed effect of decreasing property tax revenues, we're going to feel it in a couple years. And that's why we're going to talk a little bit later about the importance of long-range financial planning and looking at not just your budget this year, but what does your budget look like for the next 10 years, which we do that for all of our clients. And I know it's a lot to make assumptions for the next 10 years, but it's better to look now and figure it out than look later and be caught unaware. So planning for the imminent financial crisis. You really should prioritize your expenses. I'd like to think that I came up with this, but I didn't. A client of ours did. And it was really smart. It was an agency that said they went through some hard financial times, and when they got out of it, they said, we're through that. What we need to do now is prioritize our expenses into 1, 2, 3, 4. 1's being the most essential. It's important. 2 is it's important, it's not urgent. 3 is kind of, you could take it or leave it. And 4 is the first thing to go. All the 4s were the first thing to go. And try and do this at a time of non-crisis each year during your budget process. And that's something we can help with too. If it's, boards tend to get very territorial on certain expenses. And we can help as a third-party facilitator to help have these discussions in times where you make decisions when you don't have to, so that your position to, in a crisis, go, okay, we can drop the number 4s and let's see what happens to our financial situation. We're able to create financial models to take your budget, categorize it, drop the number 4s, and automatically see what it does to your cash position, not only today, but 9 years out. And then what happens if you drop the 3s? We can build that into the model as well. So how can we balance the budget? Obviously, I think there's going to be a lot more debt financing as opposed to pay-go for capital needs, cut expenses, cut capital spending. For certain agencies, you don't have a lot of capital spending, but other agencies' capital is huge, like water infrastructure, pipes, reservoirs, things of that nature. Fire agencies, they have to buy apparatus and fire stations and replace this and that. We were already faced in most of our agencies with aging infrastructure. So delaying even capital spending even more is going to exasperate it. So the expense reductions that we're seeing with our clients right now, the immediate one, and it's the 4s coming down, right, is the training and travel was cut. That was considered a 4 at almost every one of my agencies. Now, nobody wants to travel right now anyways. Let's be real. But looking at what do we spend on training and travel and cutting it in half, in a quarter, because we're going to be attending conferences online. If we even attend, some of these conferences are attended just to network with other people, and you kind of lose that in the setting. So conferences will be condensed and certainly cost less too. Deferring maintenance and capital projects, that's the first thing to happen. So we're going to see the impact of that 5 years down the road as we defer all this maintenance that should be done during this time. Non-essential consultants, and I would note that CPAs, we are essential consultants. Now more than ever is the time to do financial planning. It's not can you afford to do it, it's can you afford not to do it, to see where's your future going, where's your cash position going to be in 5 or 10 years based on your trajectory right now. Delaying equipment and software upgrades, we're seeing discontinuing associations. I had one agency that we looked through their associations and they were a member of 35 different associations, and some of them, they actually didn't know what they were. So that was a great way we could cut that right away. So that made it easy. And negotiate with suppliers. I don't know that anyone's had success with that, at least not any of our clients, but would love to hear it if you have. And then obviously there's the biggest percentage of almost any agency's budget is personnel costs. So that's where you're going to look to get the low-hanging fruit. Almost every agency that we work with has had a hiring freeze right off the bat and just said, okay, we're not going to hire any more people, except for a few positions that were critically needed in a couple of our water agencies. Some have considered furloughs where there's a reduced schedule. I know that my libraries have considered that. A furlough is where you let somebody go, but you want to bring them back at some point, or you go from 5 days to 4 days, and then don't pay them that extra day. So that's a 20% reduction in costs. Going to layoffs, that could well happen. That tends to happen later in public agencies as a last resort. Reducing or eliminating the call, as many of our agencies have done that. Just not even if they needed to, but in the spirit of how does it look when we're giving ourselves a big, 3% increase when the rest of the world's getting nothing. Or not the rest of the world, certainly, but many people. Suspending vacation or sick cash outs. That's a good one, and that's an easy way to get a little bit of less expense in. Golden handshakes. We've took this as an opportunity at a few of our clients to look at and really analyze who are our more expensive employees. Are they close to retirement? Is that something we want to help facilitate and then maybe not fill that position? Or if we do fill that position after they retire, we would fill it with a lesser cost employee. And that'll be a cumulative effect. And some of the agencies need this cumulative effect. Having employees pay more towards their health costs and their pension costs. There's still a lot of agencies out there that pay 100% of the employees' medical, dental, vision, and the employee's share of the pension. The optics of that is going to go south pretty soon, depending on how long this plays out. Eliminating some benefits like retiree health benefits, a 401k or 457 match, that's been considered and being considered by a couple of our agencies. And outsourcing, you do have the opportunity to outsource. It lowers your staff and benefits costs. We currently are the outsourced accountants for about, Ian and I'm referring to, for about 30 special districts in Southern California. And our agencies have just found that it's cheaper to have us outsourcing and doing the higher level accounting and the monthly board financials and the audit prep and the budget prep than to have a full-time CPA on staff with all those retirement costs and benefits. We do it for a fraction of the cost, and then we have a pool of CPAs that they have access to. So maybe this is your opportunity as an agency to restructure and look at how you're doing business. And consolidation of agencies. There's already been a lot of talk in California, and I can't speak for the other states, about consolidating smaller special districts into larger special districts or into cities. and so on. And it may come to that. Agencies that don't have a lot of reserves to draw down on right now may find that they're not fiscally viable. And that, I mean, I just suspect we'll see a lot more in that area going down the road. And with that, I will hand it back to Eric to talk a little bit more about other things you can do.
Thank you very much, Cindy. As Cindy mentioned, governments do have solutions to balance budget. They can raise revenues, which is highly unlikely in this environment, or cut spending, which is a given, issue debt unless it's limited by law, or use one-time reserves or monetize assets. Asset monetization is one thing governments frequently forget. If there are fewer employees, though, office space may be freed up to lease. Buildings may have flat roofs for solar panels that can turn your community green. Buildings may also serve as a transmitter site for cell phone towers. After all, if people are working remotely, cell phone service is becoming essential. And with the conversion to 5G cell service around the country, more towers will be needed. That presents your government an opportunity. Many governments are considering, as Cindy mentioned, shared services combining and so on, or even public-private or public-public partnerships. The key, though, is whether those transactions make economic sense. Eide Bailey can help you determine that through careful analysis of assumptions and forecasting cash flows into the future. But before a government determines any monetization, laws, regulations, contracts, grant revenues, and so on, not to mention politics, those all need to be hashed out before the solution is arrived at. Just remember, one-time solutions are just that, one time. Once they're gone, what's next becomes a huge issue. Some governments, as I say, may sell underutilized assets as part of this right sizing. Something that is a solution to a budgetary hole, as long as the government realizes that it may be selling the property at a very low value. Prices have fallen recently in some jurisdictions, so just be aware. Finally, some have asked about, as Cindy mentioned, delaying or adjusting defined benefit plan contributions or contributing assets even to defined benefit plans, or even using defined benefit plans as collateral for PPP style loans. These ideas could work depending on laws, regulations, plan provisions, and again, if the transaction makes economic sense. In many situations, delaying contributions is against the law, so just don't do it unless you're sure the law is on your side. There's also a gap provision that might result in such transactions just not making economic sense. If the plan is within the same reporting entity, such as a single employer plan, if you decide to contribute assets to the plan, such as a building, the difference between the carrying value of the assets and any consideration paid to your government from the plan, either at once or over time, is the contribution. But the plan undoubtedly would require only assets that generate cash flows to pay benefits. Bottom line, this is easier said than done. As Cindy mentioned, another thing to consider is a government combination. GAAP is a little easier here, and undoubtedly it may be considered by some of you. Governments may merge or seek to be acquired. Certainly operations may transfer or be disposed of. Again, the transaction needs to make economic sense. After all, once a program or agency is transferred, it's gone. Back in the last recession, many agencies merged in my state government, and in fact, most counties dissolved except for the county jails. One thing that is going on is a lot of folks are speaking about it. On May 28th, I'll be part of a panel that is put on by the Volcker Alliance talking about these and many other possibilities that governments are considering. The panelists range from a professor at the Wharton School of Finance at the University of Pennsylvania to the former mayor of Philadelphia, all of whom are helping governments across the country realize that there could be other solutions other than cutting budgets or raising revenues. But what about cash flow planning? It's almost a vital activity. Back in 2008, when I was a preparer in government as a controller, we prepared cash flow daily. Given the technology we had back then, that preparation was pretty much a chore. Uh, but it was essential. We started off with a heat map of our inflows and outflows, and you can do pretty much the same thing. Figure out your sources and uses and where you think the cash flows will change. List them out, or in fact, like I say, make a map. And so the forecasting is becoming vital. With that, I'd like to hand it over to Cindy and then again to Ian as well.
Thank you, Eric. We'll talk a little bit more about cash flow forecasting. As I mentioned earlier, for many of our clients, we are kind of the part-time finance director, so we prepare the budget for the next fiscal year. We never, though, just prepare 1 year. So we want to look at that budget in context of how does it mesh with the next 5 years or 10 years. We typically will give it another 9 years, although you can do this in as short as months and quarters, but we look at it annually, and we project the revenues, expenses, and capital spending and debt funding for the next 9 years, in addition to the budget year coming up. So it can give you a context of what you're doing this year, how you're budgeting, how it's going to impact future years. We had a client recently that put together their 1 year budget, and we said, okay, we want to take it and project out 9 years. And they said, okay, go ahead and do that. Let's see where the cash is. And they quickly could see that what they were planning for this year was causing a problem for years on out, because there is somewhat of a compounding effect. And it helps for them to get, it helps for you to get a visual to see where's your cash going. And so we'll also look at what your reserve policy is compared to what your cash balance is. Now, it may be that your cash balance is going down every year, but you're still above your reserve policy. So you may feel comfortable about that, and that's a planned use of reserves if you're fortunate enough to have reserves. But if you're not, then it becomes a problem. We typically always create an assumptions page so that we can play with the different assumptions and different variables to see if we change rates, how will this change? If we increase our capital spending by 3 million, or we want to do that big project for 3 million next year, can we do it? And we recently did that with a client, and we had 2 big projects that we needed to do for water compliance. And it became obvious in the financial model that we put together that they were going to need to issue debt if they wanted to do those 2 projects, that it was going to impact their reserves substantially. So that assumptions page is very helpful. Getting a capital budget if you have a lot of infrastructure. If you don't, say you're a cemetery district, you don't have a ton of building, that's not, the primary driver, or mosquito district, you're not really capital intensive, that's not as important. What is probably more important is controlling costs and really looking at those very closely, at those property taxes coming in, and looking back even at 2008, how did your district fare in 2009 and 2010 and years like that? And that may be a precursor of what's going to happen this time. And if you don't have a reserve policy, now's a really good time to create one. It's good to think about how much cash should we have on hand. I think that we're very fortunate in that the majority of our clients have a good solid amount of cash on hand, or have a plan to get that cash on hand. So we'll be able to withstand this storm, but some agencies don't keep a lot of cash on hand and can't, due to the nature of their agency. And so cash flow forecasting is probably more important than ever. One of our clients is 95% grant funded, and they do their own budget, but they would like us to put together a 10-year forecast with some, to create variables so that we can look at what happens if they lose 2 of their largest grants. That will impact them significantly. This agency is also in a public retirement system. And so if they lose, 2 of their biggest grants, they're going to need to lose staff, and their pension costs are going to go up. There's just a multiplier effect that you're able to do when you prepare a cash flow model. So with that, Ian, I think I'd like to transfer it over to Ian now to go over. He's going to go over one of our more simple models that we've done, and then I'll go over one that's a little bit more complicated. I'm not going to get into the really complicated ones, and it's too much to share, but feel free to ask any questions as we're going along too. I would be interested in the Zoom webinar chat area on the right-hand side to see how many of you do a cash flow forecast right now, and if this is routine for you already. Okay, Ian?
All right, okay, thank you, Cindy, and I appreciate all your insight, Eric, as well. Thank you both. My name's Ian Berg. I'm a consulting services manager at Eide Bailey, and creating these 10-year cash flow projections is one of my favorite things to do, to be honest, in my normal workday. So it's a good season for me, although a lot of these look bleak with the current situation. It's a very important thing that we're doing here. You can see my screen, right? I just want to get a double check. Okay. So like Cindy mentioned, this is one of the more non-complex models that we've created, and we chose to show this to you just so we can get a more easy look at how we do this and what goes into place. So the very first step you're going to take is obviously developing your next year's budget. And you can do that based on current year actuals, history, if you want to take 3-year averages, whatever you think the best method to be would be. That's going to be your step 1, is create next year's budget. What does that look like? And I know we have a lot of maybe 1-year, 2-year potential factors that you'd want to consider when creating those budgets with the coronavirus and this pandemic. So as we look at that, you can see, you've got all your revenues up top, you've got your expenses down below, and these would be either expenditures or expenses depending on what type of agency you're working with, special district or government. And you get to your bottom line, you look at your cash, and you get to your ending cash for that year. And as we build out this current year, as you can see, there's a lot of detail that goes into it. So we do have main categories such as your total donations and grants, total property taxes, things of that nature, but we do get into the dirt with what goes into those. So each of those might contain various property taxes or various different types of other revenues, interest revenues, things like that, and that goes for your expenses as well. We look at things like total salaries and wages, but we separate that out maybe based on your salaried, hourly, employees, things like health insurance. There's a lot that goes into it. So not only are we looking at the big picture, but we drill down into the detail. And then once you get a good picture of how that year looks, then you can start building out to the next 10 years, 5 or 10 years, whatever might work for you. And as we go out that, as Cindy mentioned, it sort of compounds and you project where are you going to be at the end of 2029, 2030? What's our cash going to look like? And we build out the cash analysis at the bottom of this detail here. So as you can see, they're out of cash by about year 6 here, I think it is. And they go below their reserve policy by year 5. So with this particular situation, they know ahead of time, hey, we need to do something. We need to cut our costs. We need to, figure out where are we going to get other revenue sources. And as we look at that, we have a more summarized version of the 10 years. So the revenue is up here, as you can see, for the 10, expenses down here, and then another cash analysis. So if you want to get an easier look at everything that was shown on the more detailed page, we build that out over here. And what that's going to do is consider all of these assumptions over those 10 years. So we've built these in to link into the detailed budget based on line item. So obviously the property taxes here, those are going to associate with the property tax revenues. So as we anticipate maybe a decrease in the next couple years, definitely not an increase. We have these remaining very flat over the 4 years and then taking small increments of an increase over the next 6. And we have a very interesting situation with this district in particular. They have a parcel assessment, a special assessment that actually sunsets in 24-25. So with this, we're considering that they would not get that special assessment by about year 6. And it makes a decent amount of their pie, of their revenue intake. And as you can see, that special assessment is almost a quarter of their revenues. And it's making up about 23% of what they're getting in a year. And that's going to be under here under the property taxes and assessments. And it's this special assessment line here. So you can see that they've got it in 2021, looking at about 850 grand. And then the next 3 years after that, and then it disappears if they don't get that renewed. So it is very important that they look at that and do whatever they can now ahead of time to make sure that that does get renewed. And if it does, what do they need to renew it at? So if they were to renew it at, say, about $1.2 million for the assessment after it sunsets in 24-25, then we look at their cash down at the bottom and we see, hey, it's actually not that bad. They run out of cash. They actually don't run out of cash for the 10 years, but they do dip below their reserve policy. And so that's a good thing to look at as they face the decision and the politics about getting that special assessment renewed in about year 5 there. So things like that, you can play with these assessments and change different scenarios to see how is this going to play out and what's our agency's position going to be like in 5-10 years, and what do we need to do to make sure that it's a healthy position. We do other things like a cash graph here just for a nice easy visual to see, okay, here's our reserve line, that's the gold line right there, and here's our cash. So as you can see, they stay above the reserves, year 5 they go below, and then they're out of cash. So they want to do everything they can to make sure that that property tax or that special assessment is renewed here. And
Ian,
then their cash
renew it at 1. Just renew it at 1, not 1.5.
So if they do renew it at 1.
So meaning 100% of what they're currently assessing.
Exactly.
They want to increase that assessment.
Exactly. So if they renew it at 1, they do run out of cash by year 9. And they dip below their reserves at year 5. So they want to do everything they can to make it an increase in what the special assessment was to keep their district healthy. And looking at that, other things they could do is look at the total, where their expenses going, where their outflows. And they have a very large portion of their outflows on salaries and wages and their taxes and benefits for their employees. And in particular, they need to be looking at what can we do to fix this situation, and what are we going to be able to do to cut some of those outflows to keep those revenues that we work really hard for, that we really have to spread thin to make our district feasible and to ensure that they're providing the best service possible. And looking at that, I think I did touch everything. Cindy, was there anything else?
Sure. No, I think that's good. Oh, I can't believe I got that right. Okay, this particular agency is one of our water clients. And here, I need to get rid of the panel there. Okay. And we do the 10-year, and this is the summarized version right here that we're looking at of their operating expenses. And then we get down to kind of our net revenues available to fund capital, because very capital intensive water agencies are. And we look at what are our capital expenses, and then it brings us down to our bottom line. What's our increase or decrease in fund balance? And then we project what our beginning cash will be, and then that'll show us the ending cash. And that's kind of how the model works. And as you can see on this one, we use conditional formatting to highlight in red when we are below our target reserves. And this particular agency has had a history of doing 6% rate increases, and that's really what the board in the past can tolerate, and they don't have a desire to go any higher, which is fine, except where they have a couple of big capital projects. So if we look at, we have their capital project plan is interspersed and linked into the detail. And next year, they have these 2 big projects. And these big projects are really what's driving this negative below the reserve policy. As a finance person, I can't tolerate the cash getting that low at this particular agency. And so we had to have the talk with the general manager and say, look, let's consider going to 8%. And if we go to 8%, we can see there that at least in year 6, we're going to be above our reserve policy. And then in year 6, we can drop it down to say 2%, and then maybe nothing, or look at it then. So we want to be able to play with it to see the net impacts right on the screen, to kind of, it's really a dialogue with management, and until we get to the point where we think we have what is perhaps a good rate increase. Now in California, we're governed by Prop 218. This particular agency is doing a rate study right now, and we want to see, we want to see what the outcome of the rate study is going to be, but we already know that we're going to be in around the 8% range. We do have an assumptions page, just like every other client. And here's where we have the rate increases. We've got to look at what are our volume changes be. If your agency, if you're a water agency with a lot of commercial property, you may see a decrease in that. We've also factored in some COVID-19 forgiveness, that we're just erring on the side of caution and assuming that we've seen a 30% increase in customers not paying their bills in the month of April, and we're assuming they're not going to be able to pay. So we've got a lot of variables that we're adding into that. And then of course we have the cash graph to see where are we going to be, where's our reserve policy at, where do we want to be, and so on. We also link in personnel detail, and I've made this fairly generic, by position, by employee, and we look at what their increases will be, what will be their salary, we project their overtime, their vacation and sick, their PERS, their retirement, their Social Security, if they're also a Social Security agency, down to state taxes, down to the medical, dental and vision, life costs. And then for most of our agencies, we do an all-in cost. We also factor in workers' comp, and then we get a fully burdened rate, which is used for other things in addition to the budget. And that helps us look at, when we did this at one of the agencies, and this particular other agency was a district primarily reliant on property taxes. That's when we looked at it and said, we've got a couple really high level positions that we may consider giving them a golden handshake. And then in particular at this agency, we spread it out by month and looked at how April, May, and June are going to have considerably less residential water, business water, and so on, how less water sales, less collections. We'll have the revenue, but we'll have the corresponding equal bad debt expense. So that's typically what we do, and we can play around with it and kind of tailor it to each client's individual needs. So we take their budget and then we tailor it to their specifications, their assumptions. We work with them to come up with the answers, because and a lot of times they don't really like the answer. So, but they would rather know now than later. And with that, I think we're happy to answer any questions. Eric, I want to say thank you too. You've done a great job. I'm going to hand it back to you for some final thoughts.
Thank you, Cindy and Ian. This is great. And again, all of us here at Eide Bailly have the ability to help you and your government to navigate through this really uncertain time. That's what we're here for as your trusted advisors. We will go through these assumptions with you, build a model, and discuss with you alternatives to raising revenues or cutting expenses. You know, and again, sometimes that just doesn't make sense for many governments, and we're here for you. With
Eric,
that,
can I just answer a couple questions?
yep, I was going to hand it over to you. Yep.
Okay, I'm happy to give you examples of some reserve policies that we've developed. As far as the template, it's really going to be unique to your agency. It's
right.
We've tried to build a template that would be like a generic one size fits all, and we found it just really doesn't work. So there's nothing I can share with you that you'd probably be able to use. But we'd be happy to work with you and set up a template that you can use and update going forward. Ian, like Ian said, that's his favorite thing to do, and he's fairly good and fast at it. So we'd be happy to do that. And we could also share with you, say in a PDF, kind of the format that we try and use. But I hope that we've shared the essence of how you should build out that model with the projections, assumptions, cash flow, reserve policy. All of those things factor in together to build out the best plan, future plan for your agency. So I think I'm done. If I've answered any questions, feel free to email us or submit any questions afterwards. And thank you all for attending. We appreciate it.
Yeah, let's. Here's our contact information. Feel free to come and talk to us. We thank you for spending the time with us, and please feel free to reach out to us. We're more than happy to help you at any time.